Hello students, my name is Shesi George, your accounting professional lecturer. In this video, we are looking at transfer pricing, okay? Transfer pricing. But before we look at that, please subscribe to my YouTube channel, Georgian Theory Concepts, okay? Now let's get started. Transfer pricing. Now, the question is, what is transfer pricing, or what is a transfer price? Let's take, for example, we have a company XYZ, okay? And this company has two divisions, okay? Division, say S, and division B, okay? Don't forget, both divisions are of the same company, okay? But they are located at different geographical area, but they are still part of this company. All right. Now, this division, there will be a manager here in this division. There will also be a manager here in this division. Then each manager will be running this division as if it is their own. Okay. This one too will run this division as if it is their own. Okay. Now, the decisions of these two divisions must be tailored with the objective of the company. All right. So they will be given the autonomy, the freedom to run the division as if it belongs to them. But their decision will always be tailored to this. All right. Now, let's assume that this division S produces a product that is intermediate product. It produces an intermediate, okay, product, and division S produce finished goods. That is the finished products, okay, finished products. Then this intermediate products, when I say intermediate, it means it will be used as part of the raw materials for these finished products. Then it will be ideal for B, take note of that, to always buy these products from S instead of going to external supplier. Okay, it will be ideal for B to patronize S because they are of the same company. Okay, all right. Now, the price at which S sells to B, okay? The price at which S sells to B is called transfer price. All right. So what is transfer price? Transfer price is nothing but price that is charged by a division, okay? That is charged by a division. All right, write it down. It's a price that is charged by a division, or a price a particular division, that's the selling division, charge another division, all right, of the same company. So the price, the selling, so this one is called the selling division. So the price at which it charges another division for an intermediate product, okay, is called transfer pricing. Or for goods and services, intermediate goods and services, okay, the price at which a selling division charges another buying division of the same company, that's what we call transfer price. Do you get it now? That is transfer price. Are you with me? Okay. All right. Now let's look at the objectives of transfer price. The objectives of transfer price. Number one, we have performance measurement. You know, as a divisional manager, each manager will be measured by the profits made. Okay, each manager will be measured by the profits made. That is when we talk of performance measurement. All right. So transfer price can aid the efficiency or the effectiveness of each manager when it comes to performance measurement. So transfer price when the ideal transfer price, so we are coming there, when the ideal transfer price, I even love to treat this objective as the last. So by the time we practice some questions, so that's when all these objectives, you will understand them, okay? Then goal congruence simply means that the division's decision, the division, whether the selling division or the buying division, their goals must be tailored to the objective of the company. All right, their decisions. You know that each manager has been given the liberty to operate, okay? So their decisions must be tailored with the company as a whole. All right, now autonomy. I've explained that each manager is given free hand, okay? They are independent of each other. They are giving they are autonomous. That is, they are independent. Then transfer pricing brings about bookkeeping, okay? Bookkeeping is just a bookkeeping. That is moving goods from, say, division A to division B, you know? So we need to record. So transfer pricing is just a bookkeeping activity. Are you with me? Because A and B are in the same, they are in the same company, all right? Or X and Y, division X and Y, they are of the same company. So it's just like movement of goods from one division to another. So we need to document it now. Then motivation. Transfer price motivates the managers, okay, all right? It motivates the managers in the sense that each manager wants to, like the selling division, we want to maximize profit. Then the buying division, we also want to reduce costs of operation, all right? So they must look for the ideal transfer price that will maximize their profits. So A must help B, B must also help A. So that gives birth to the concept of the determination of ideal transfer price, okay? The determination of ideal transfer price, all right? Now, what do we mean by ideal transfer price? Okay, ideal transfer price, and what I call the economic transfer price. So in a nutshell, the economic transfer price, the examiner may ask you to determine that, all right? Let me just go straight, instead of too much story, is for the selling division, all right? The minimum price the selling division can charge, minimum. The minimum price it can charge is the variable costs of the selling division. That is the minimum price it can charge as a transfer price. Okay, I want to help this buying division. Then it must be less or equals to transfer price. All right, it must be less or equals to transfer price. Then transfer price must also be less than the maximum, that is from the buying division angle. I can take the buying division, the maximum TP, transfer price, this is the minimum transfer price, must be the variable costs of the selling division must be less or equals to transfer price. Then transfer price must be less or equals to external price. External price. That is the price at which, that is the lower. So look at this, the lower of either the external price or the net marginal revenue. And what is net marginal revenue? The selling price of the finished goods minus the variable cost. The selling price of the finished goods. Don't forget, I told you from the beginning that buying division deals with, it produces finished products, but it uses intermediate products as part of the raw material. Then that finished product must be sold to external customers, okay? So the selling price at which it will sell the finished product, that's the finished goods, the selling price minus the variable cost of production, it gives us the net marginal revenue. So the maximum price it can take, all right, it can allow, let me put it like that, from the selling division is the either external price, the price at which it will buy the intermediate product from external supplier. The price at which, don't forget, don't mix these two together. This is the price of the intermediate product, of the same intermediate product it will get internally from outside, okay, from outside supplier, or net marginal revenue. So the one that is lower will be the maximum transfer price from the buyer's angle. All right, why the minimum transfer price will be this. Okay, all right. Then the next aspect is the pro forma for profit statement. Okay, where only internal sales are made by the selling division, but it will be viewed from two as perspectives. So you write selling division, buying division, then the company as a whole. Don't forget, the selling, both the selling and buying are of the same company, all right, as a group. So we have the external sales. So selling division does not sell to outsider in this case. That's the assumption. But it's sold to the buying division. Internal, that's internal sales. That's the transfer. So you put the figure here. Then the finished product, how much do we sell it to external customer by the buying division? It will be here. So that forms the total sales of the company as a whole. All right. Now, costs. Of course, we have the transfer cost. So this is the transfer cost. So transfer price to the buying division is known as transfer cost. Transfer cost. Don't forget, this is not total cost. That's transfer cost. But to the buying division, it will be transfer price. To the selling division, it will be transfer price. But to the buying division, we can call it transfer cost because it's a cost to him. Because that's the cost is buying from, because it's buying from the selling division. So we call it transfer cost. All right. Then for the company as a whole, it will be dash. For the company as a whole, it will be dash. Take note of this. Then other variable costs apart from the transfer cost. Then the selling division also will incur. The buying division will also incur other variable costs apart from the transfer cost. Apart from the transfer cost. Then fixed cost, of course. Then you add, then you subtract from the sales. You subtract from the sales, you subtract from the sales. Then you add these two together to give you this. Don't forget, for transfer costs that will be dash here for the company as a whole. Anything transfer, it will be dash, dash. So it's just the movement of product, movement of goods within the same company. Okay? Then pro forma 2 is where both internal and external sales are made. The selling division, by the selling division. That is, the selling division also sells to external. Then it's, apart from external, the intermediate product is also sold to the internal division, okay? That is internal sales, then external sales for external buyers, all right? Then this is the sales of the buying division of the finished goods, okay? Then you add these two together, it forms the sales of the company. But this one is for external. Then the one for internal, okay, will be dash here. Then it will be dash for the company. Then the costs remain the same. The cost will be treated the same. All right. Then lastly, we look at production capacity. Production capacity. So for the selling division, All right. The selling division, supposing the selling division has the capacity to produce, that's his own production, to produce 10,000 units. All right. So before you can determine the price that you will sell to the buying division, and the buying division, the demand for buying division is 8,000 units. Okay. Do you know what the selling division will do? The selling division will consider the external demand first. Take note of this area. This is where the question normally lies. The external demand. Okay, that is the customers outside that want to buy the same intermediate product. External demand. Let's say the external demand, say, is 6,000. All right. The production capacity of the selling division is 10,000. Take note of that. The buying division, their own demand, they needed 8,000 units. But this selling division has capacity for 10,000 units. All right. So now, what the selling division will do, number one, is to determine the external demand. Is there any external demand? Okay. If yes, so what the selling division will do is to divide this 10 into 2. How? It will say external demand. How much? That's 6,000. You now say the remaining one will be 4,000, and the total is what? 10,000. Okay. Now, what price? This one is at what price? This one is at what price? That is where the ideal price comes into play. So if, according to the selling division, take note of that, their variable costs, okay, let me put it here, their variable cost is 50 naira per unit. Don't forget, according to the selling division, their variable cost is 50 naira. And their variable cost is 50 naira. Then they can also sell external selling price, say is 100 naira. Are you with me? Or let me say their contribution, this variable cost plus contribution per unit, which is 30 naira. It means that when they want to sell for external, they will be selling, what is variable plus contribution? That is selling price. So they will sell at variable cost plus the contribution. Are you with me? Which is what? 80 naira. Because there is external demand and they can make contribution of 30. So for the internal, this one is, they can now say, okay, for internal price now, my internal price, I want to help the buying division. I'm helping him, so I will sell for the variable cost. So they can sell this for 50 naira. Do you get it? Okay. The selling division determines the external demand. It has a production capacity of this. Then the variable costs of the selling division is 50 naira. The contribution per unit is 30 naira. It means their selling price is the addition of this and this. And that will go for external demand. Then the remaining one, this 40,000, because the external demand is just 6,000. So they will sell for 80. Then they will sell this intermediate product for 50. Okay? This 4,000, they will sell for 50. So what the buying division will do is to pick all these 40 first. This 4,000, okay? They will sell for 50. That's variable cost, which I told you the minimum ideal price is the variable cost of the selling division. Then the remaining 4,000, they will now buy at the rates of 80 naira. So that's the ideal transfer price. So you now find the total of this. Okay, it will now be the transfer costs of these 8,000 units. All right, so you can replay the video to get the explanation. So in the next video, I'm bringing a question, a standard question to solve. Okay, then the policy of the company, you must follow the policy. So with questions, I'm going to explain the policy of the company. The policy, sometimes we say that the selling division must sell to the buying division, and the buying division must buy from the selling division. So this is how you determine the price, and this method is called the opportunity cost method, and that is very common in the exam. All right, opportunity cost method. Okay, so if you love this video, please share with your friends as you do. God bless you. Thank you. Meet me in the next video. Bye.